Hello and welcome subscribers to the Saturday Summary for July 12th of 2014, your weekly summary of market and economic news for annuity life insurance professionals. I'm Jonathan Illig, Executive Sales Consultant for Brokers Alliance, here for the biz. Well, the first full week of market activity for July saw the broad indexes that we track decrease. The S&P 500 and the Dow Jones Indices fell by not quite 1% each. The NASDAQ lost just over 1.5%, and the Russell 2000 Small Cap Index fell by almost 4%. This brings the Russell back into negative territory year to date, with the Dow Jones at 2.21% at mid-year and the S&P 500 positive by 6.45%, which had only one up day for the trading week. Now, the yield on the benchmark 10-year U.S. Treasury Note is now lower than it was 12 months ago, closing on Friday at 2.52%. This is a drop of over 16% year to date and about 2% lower than at this time in 2013. Now, this drop in yield is reflective of demand. Remember, as demand for U.S. government securities rises, the yield drops. Increased demand is generally indicative of large investors and institutions seeking safety, but it's also a result of the Federal Reserve's stimulus policies. Now, speaking of the Fed, this week saw the release of the June minutes of the Federal Open Market Committee meeting. Again, that's the group that sets interest rates and policies. There were no surprises in the minutes, and they seem to confirm that the quantitative easing, or QE, stimulus that has been underway for nearly 6 years in one form or the other will end in October. Overall, the markets ignored this coming reality that the Fed is going to take the punch bowl away from the party. You can read more about that and the probable consequences in an article at page 6 of the written summary. Now, the big news this week was more trouble in Europe, thus our Four Shocks headline. The second largest bank in Portugal, Banco Espírito Santo, missed a $1.6 billion interest payment on some short-term debt to other banks. Now, this initially sent the markets reeling. The Dow dropped 160 points. But as always, the trading computers just saw it as an opportunity to buy the dip. Now, why should you care about a bank in Portugal? Well, it's a couple of reasons. First, the amount of global debt financing is again at record levels, larger than before the onset of the 2008 financial crisis. Now, a spike in interest rates, which is expected at some point, can really create havoc with the leveraged debt that has been a driver in the stock markets. As discussed previously in this summary, corporations have borrowed record amounts of money to buy back their stock. And several articles this week pointed out that much of this borrowing has now been with secured lending, which counterintuitively seems to pose larger overall risks than the unsecured corporate borrowing that was common before the financial crisis. The article on page 7 will provide you with more insight to that. Now, second reason, because the whole global financial system is interconnected, and the fact that the missed payment was short-term debt. Now, this is often called commercial paper. For several weeks, there have been reports of some problems in what are referred to as the repo markets. Specifically, repo refers to repurchase agreements between big banks. Briefly and simply, the big investment banks fund their daily operations by constantly borrowing large amounts of money from each other on a short-term basis, even daily. To do so, they post collateral such as bonds, and they agree to repurchase or repo that collateral from the lending bank at a short time later. Now, the global repo market is estimated at $1.6 trillion every day. It has been described as the oil that greases the wheels of the financial system. Now, the reported problems in the repo market is a huge sudden increase in the number of what are called fails to deliver. This is when one bank in the deal fails to actually deliver the pledged collateral. Now, historically, a spike in these fails are associated with rising nervousness in the financial system. Now, in my simple view of things, it's kind of similar to a headache that is an unseen symptom of a brain tumor that is yet discovered. So again, why should you care about a Portuguese bank and repo markets? Ever heard of a money market fund? The repo market is one of the major areas that money market funds invest in. That is the short-term trading of commercial paper and very short-term bonds and notes. In fact, the first major trigger in the financial crisis and the collapse of Lehman Brothers was when the repo market ceased to function, and the big banks could not fund their operations because the other banks did not trust the collateral. Economists refer to this as a liquidity crisis, meaning that the big banks can't pay their debts and bets to each other. This is why you should care about a bank in Portugal. And if you are within a few years of retirement, you might want to take advantage of the safe money financial tools that guarantee your retirement assets against loss. As Mark Twain said, history does not repeat itself, but it does rhyme. We close this week with the quote of the week from Mr. Rob Arnott. He's the chairman of Research Affiliates, a firm managing $178 billion in assets. Well, in an interview on Friday, he said, "I can say with a high degree of confidence that investors are going to get very disappointing returns from U.S. stocks over the coming years." Well, that's your Saturday summary for July 12th of 2014. Have a great weekend. We'll see you next Saturday.